Hello investors, my name is Edwin Epperson, manager of Blue Bay Capital, and I am helping capital investors like yourself make wiser and more informed decisions. Today we're going to be discussing a comparison between note investors and rental property investors. Remember, cash flow is king, we know that, but the big question is it with or without liability? Sir Richard Branson has famously said, never take your eyes off cash flow because it's the lifeblood of business. So in this discussion, we're going to cover the two different investor types. Remember, these are cash flow seeking investors that want their investment secured to real estate. We're then going to actually discuss the flow of cash, meaning how is the money used on both sides? How is it earned? And at the end of the day, what does that relate to as far as a return on investment? And then, of course, we're going to talk about the tax advantages from the private lending perspective and from the rental property perspective. Last but not least, we will discuss how Blue Bay Capital's turnkey private lending solution can answer those hurdles and address those hurdles that private lenders face when they're trying to find a truly passive investment strategy. So let's get started without further ado. Investor type. So again, the two investor types are your private lender and then your rental investor. Private lenders typically play on the debt side, and then rental investors or rental property owners are typically playing from the position of equity. Now, their goal and focus is building equity, but of course, cash flow, right? However, the way that they approach their investments is through an equitable lens, okay? So let's go ahead and dive into this. Private lenders, they are all about passive investments, minimal time. They want the least amount of risk as possible. They actually want to have control over the deal, but not the ownership. They want minimal headaches. And more importantly, they want to play the cash flow game by the bank rules. Now, rental property investors, they are all about building equity. They are comfortable with risk. They're okay with the risk that it takes assuming ownership. They want to use leverage, meaning they want to use the private lender's money to help them buy properties. They're comfortable with the 3 T's, termites, tenants, and toilets. And of course, they love to play the market. But not every investor is always the best type. So there are disadvantages to each type. If we look at the private lender, the type is disadvantage is going to be a high bar to entry, meaning you have to have quite a bit of money to become a private lender. You have to be okay with high risk without the full education possibly. You're going to have to be okay with the borrower type. You need to know who the borrower types and who you're lending to. You will not be participating in the equity unless, of course, the rental property owner fails to make their payments and adhere to the note and the mortgage. And this is strictly a cash flow position, a cash flow play. Okay, so if your goal is, I want to be a private lender, but I also want to participate in the equity, then maybe you should be a rental property investor because private lenders do not participate in the equity unless the deal goes south. So again, strictly from the cash flow perspective. Rental property owners, they must have good credit. You cannot leverage unless you've got good credit. If you're borrowing money from a bank, you will face bank limits on how many properties you can own. There are multiple expenses that we'll get into with owning real estate property. You do, of course, you're comfortable dealing with the 3 T's, but that means you will deal with the 3 T's. And above everything, taking all this into consideration, if you're going to utilize leverage, then your cash flow will be reduced. So let's go ahead and actually look at what this looks like. So let's take an example where we look at both the investor types on the same deal. Here we have the borrower who is going to buy a rental property. No rehab is needed, and a tenant is waiting to be placed as soon as the borrower buys. All things being equal, the property, the borrower, and the deal are solid and pass the lender's underwriting. Both the lender and the borrower have $150,000 to invest. Obviously, the property costs more than what the borrower has, and plus the borrower would rather use leverage. The lender tells the borrower he is willing to make a $147,000 loan at 8% for 15 years, fully amortized. This means that he will be making principal and interest payments every month. His principal and interest payment will be $1,405 per month, and the borrower must pay for the taxes and insurance themselves. The borrower agrees to this deal. The lender loans the $147,000 to the borrower, and they are left with $3,000. The borrower puts down the remaining $63,000 as a down payment, and the borrower is left with $87,000 in remaining capital. The borrower signs the note and the mortgage. The lender records the mortgage, thus securing his investment. The borrower receives the deed to the property and now owns the property. Every month, the borrower will pay the lender $1,405 for 15 years until the note is paid off. In this section, we're going to analyze the flow of your profit and the differences between note investing and rental investing. Now, the borrower places his tenant, and the tenant is a hardworking firefighter. He loves his country, his city, and family. He is paying $2,000 per month in rent, which is just about 1% of the purchase price. When the tenant pays his landlord, our borrower, the borrower must set aside taxes and insurance, which is $349 out of the income. Then the borrower has to pay the lender based on the note. So this leaves the borrower with $246 in positive cash flow at the end of the month. Now, hang on with me because this is where the rubber meets the road. We are going to analyze return on investment. After 1 year, the lender has collected $1,405 for 12 months, totaling $16,860. Of that, $11,569 is in interest. Now, because every interest payment, the borrower is paying less interest or less principal because the principal is reducing. Less interest because the principal is reducing. The actual ROI is going to be slightly less than 8%, right around 7.87%. Again, if you don't understand that, because it's fully amortized, every payment, the borrower's payment stays the same, but what happens is the amount of interest that he's paying decreases while the principal payment increases. So there's this offset every month. The actual amount of principal that he's paying interest on decreases. So therefore, the lender is actually earning less interest than the full 8%. Now, the borrower has collected $246 in profit per month for 12 months, totaling $2,952. His cash-on-cash return, based on how much cash he invested to generate this annual profit of $2,952, is only 4.68%. Also, we did not account for the borrower setting aside costs for maintenance and emergency repairs for the property. If you calculate that in, then the annual income is even lower. The good thing is the equity the borrower put into the property has now grown from his original $63,000 and is now increased to $71,400. This is based on just a national appreciation rate of 4%, and this is calculated historically averaged out over the past 100 years. So that's how we came to a 4%. We understand that in every location, state, and even city, and some states are going to have higher or even lower appreciations. And of course, everything ebbs and flows with the market economy. However, the borrower has also made $5,289 in principal payments. So that's in addition to the calculated equity, bringing his total equity in the deal to now $76,689. That's not bad. But this is also good for the private lender. You see, the lender's mortgage has decreased by that same $5,289. This brings his loan principal balance down from $147,000 to $141,711. So the lender is actually in a safer position than when he was at the beginning of the year. As well, the equity that is counted towards the borrower's balance sheet is because the lender controls the asset by way of the mortgage. Should the borrower default and the lender take the asset back in foreclosure, that equity is now the lender. So we always want to keep in mind that the lender still has the potential to get that equity only if the borrower defaults. Again, the goal for private lending is not to loan to people that you expect to go into default. Now, that could actually be considered predatory lending. And if there is a rash of foreclosures that you've had to institute and it comes back that you've been a predatory lender, that could really bite you in the rear. So let's go ahead and talk about the tax advantage. Now, this is something that I realize the rental property investor is going to have a lot more tax advantages than the private lender, but I do want to cover some of them. The biggest tax advantage that the private lender has is the type of account that they are investing through. So whether it's a self-directed IRA, whether it's, a solo 401k, The only really big tax advantage is if the private lender is using a tax advantaged account, such as a Roth, and they are being able to not pay taxes on future gains. That's really where a private lender's ability to take tax advantage is the most powerful. Also, if you're just private lending out of your checking account, then it will be counted as ordinary income. So whatever tax bracket you fall under, that's what you will be taxed on that income. Now, at the end of the day, I'm not a CPA. There are CPAs that are brilliant, and you might have a CPA that has a great strategy and plan to reduce your earned income for the year, especially if you're just loaning out capital sitting in a checking account or a savings account. But my recommendation is strategize with your CPA, let them know what you're wanting to do, and then how you should structure your capital before doing your loans to best take advantage of tax advantages. Now, let's go ahead and get into the rental property. Again, it comes from the type of account. They can also use self-directed IRAs or Solo One 401ks to invest in. So they have the same ability to leverage tax-advantaged accounts. If not, the income that they're generating is going to be seen as ordinary income. Again, talking with a CPA, you can strategize that. Owning it inside of a business will allow you to use that income, but then write off that income for business expenses. So that's definitely a plus. As well as you have depreciation. That's something the private lender cannot participate in. You actually can depreciate your asset over a period of time, and that reduces your tax burden as well. Equity. The equity, you actually get to participate in the equity, which is, to be honest, based on the numbers we ran in this scenario, equity is really where it's at. You're building that future equity. And then, of course, as you build equity, you can refinance, pull that equity out. So there are some major benefits to actually being a rental property owner. At the end of the day, even a rental investor needs to strategize with their CPA to find the best tax approach to investing in rental properties. So how can Blue Bay Capital, our turnkey solution, help you if you're looking for a private lending solution? Well, we can help if you're looking for a truly passive investment that you do not have to spend time managing. If you're seeking passive income secured to real property, we can help. If you're not a paperwork investor and you hate the thought of tax prep, then that's something that we handle for you. And last but not least, if you're looking for ways to diversify your investment portfolio and participate with other sophisticated investors, then Blue Bay Capital's turnkey private lending solution is for you. Really, the last thing that you need to ask yourself is our turnkey private lending solution for you? I believe that it is. If you're truly seeking passive income, then private lending, our solution can be for you. Lower risk yet higher return with a safer investment. And if you're looking for investments where you are in control, then I firmly believe that Blue Bay Capital's private lending turnkey solution can answer a lot of the questions that you may have. That's it, guys. My name's Edwin Epperson. Thank you so much for joining me. This is my contact information. Please feel free to check out our website. We've got a lot of educational content for both capital investors and real estate investors. Please connect with us on social media. If you've got a question specifically, or even if you have a deal, reach out to me on the website, or you can find us on social media and reach out, and we can have a phone call. We can communicate back and forth via email. At the end of the day, I want to see you be successful. God bless. Be looking for other additional educational content that I'm creating. I love doing this, and I hope you have a great rest of your week.